The tax-free contribution limits of the QSEHRA 2021 scheme have been greatly improved since the initial launch. Now, anyone can make contributions to the QSEHRA scheme without having to meet the existing restrictions on tax payments. This is particularly useful for QSEHRA Limited partners that are non-domiciled. These individuals can now contribute a tax-free lump sum to the scheme. However, there are certain areas where the contribution limits of the scheme may still prove to be restrictive. It may not be suitable for higher income couples. This is because the threshold amount for EFRBS pension contributions is lower than the retirement benefits available from the QSEHRA. The intention of the QSEHRA was to ensure that high-income couples do not bear the brunt of the costs associated with the pension scheme. The introduction of the allowance for EFRBS pension contributions has been an important step towards encouraging more high-income couples to join the QSEHRA scheme. Another area where the contribution limits of the QSEHRA might prove restrictive is if the individual has a sizable wealth that he or she would like to leave to their family. In order to take advantage of this facility, it is necessary for the QSEHRA partner to have a large sum of money to give as a gift to the family members. There are many options available for those looking to leave something behind to their family. However, in cases where the assets are in the form of cash and/or shares, the rules regarding the provision of the tax-free lump sum will need to be considered. The QSEHRA scheme also allows a person to make contributions to his or her pension scheme in both the UK and overseas territories. It is possible to make contributions in the foreign territory through the QSEHRA, provided that the relevant taxes are paid. These contributions may also be tax-free, provided that the person is a non-domiciled British citizen. When contributing money to a pension scheme through a foreign country, one must remember to ensure that the source of the funds is secure. This can be achieved by ensuring that the funds have been provided through a legal investment entity. When individuals choose to make contributions to the QSEHRA scheme through a legal entity, they do not have to worry about paying any additional tax on the amount of money they have contributed. However, it is still necessary to ensure that the legal entity has a sufficient level of assets. In addition, the QSEHRA scheme allows both pre-tax and post-tax distributions of the assets of the QSEHRA member. The distribution is based on the net income of the QSEHRA member, which considers both the pension and profit accumulated during the period of service. The QSEHRA member may contribute either up to a certain amount per annum or up to a certain percentage of the total assets accumulated during the plan. There are some contributory schemes that permit members to choose how the money is invested. These include the SEBI Life Insurance Plan and the Crops Life Scheme. In addition, there are also QSEHRA member schemes that allow an individual to opt for both tax-free and tax-competitor contributions. In these cases, both the contributions made between the two periods are treated as tax-deductible contributions. In order to take advantage of the tax-free option, a QSEHRA member must also elect to make tax-deferred contributions.